May 14th, 2025, a day etched in market history. The day the music stopped and investors were left scrambling. The numbers told a story of chaos and fear. The Dow Jones plummeted over 1,200 points. A sea of red engulfed trading screens. The Nasdaq Composite down 5.2%. This was a full-blown crash. The atmosphere on Wall Street was electric with fear. Traders spoke in hushed tones. The air crackled with tension. This was a financial earthquake. From Tokyo to London, markets reeled. Financial contagion knows no borders. What caused this sudden and dramatic collapse? The truth is, it wasn't just one factor, but a confluence of events, a perfect storm that had been brewing for months. Inflation, that insidious beast, had reared its ugly head, eroding consumer purchasing power and spooking investors. The Consumer Price Index, a key measure of inflation, had been ticking steadily upward for months, flashing warning signs that the economy was overheating. Consumer spending, the engine of the American economy, had begun to sputter, sending shivers down the spines of economists and investors alike. Adding fuel to the fire were the actions of the Federal Reserve. Tasked with keeping inflation in check, the Fed had been gradually raising interest rates, but many feared they were moving too slowly, too timidly. The spectre of runaway inflation loomed large, and the market's patience was wearing thin. Then there were the geopolitical tensions. The ongoing trade war with China had escalated, casting a pall over global markets. Supply chains, already strained by the pandemic, were pushed to the breaking point. Uncertainty reigned, and uncertainty is kryptonite to the stock market. The immediate reaction to the crash was swift and brutal. Panic selling gripped the market as investors, both large and small, rushed to unload their holdings, fearing further losses. It was a classic case of herd mentality, as fear, once unleashed, became a self-fulfilling prophecy. The selling was indiscriminate, with few sectors spared from the carnage. Tech stocks, once the darlings of the market, were hit particularly hard, as investors fled to the perceived safety of value stocks and defensive sectors. The financial sector, still haunted by the ghosts of 2008, also took a beating. Banks, already grappling with the prospect of rising interest rates and a potential economic slowdown, saw their share prices plummet. It was a bloodbath, a full-scale retreat from risk assets as investors sought refuge in the relative safety of government bonds. The yield on the 10-year Treasury note, a key benchmark for interest rates, plunged as investors piled into these safe haven assets, driving up their price and pushing down their yield. Section 4. Trump's Tariff Tempest, Fanning the Flames of Financial Fear. No analysis of the 2025 crash would be complete without examining the role of then-President Donald Trump. His policies, particularly his aggressive trade war with China, had been a source of market volatility throughout his term. His America First agenda, while popular with his base, had spooked many in the business community who feared protectionist policies would harm the global economy. Trump's penchant for unpredictable pronouncements and late-night tweets only added to the sense of unease in the markets. His decision to slap tariffs on Chinese goods, announced at a rally he dubbed Liberation Day, sent shockwaves through global markets. While Trump argued these tariffs were necessary to protect American jobs and intellectual property, critics warned they would only serve to raise prices for consumers and hurt American businesses that relied on Chinese imports. The tariffs, coupled with Trump's often combative rhetoric towards China, created a climate of uncertainty that hung over the market like a dark cloud. Section 5. Echoes of Crashes Past, 2025 in Historical Perspective. The 2025 crash, shocking in speed and severity, was not without precedent. Market crashes are a recurring feature of financial history. The 2008 crisis, triggered by the subprime mortgage collapse, highlighted global financial interconnectedness. The dot-com bubble of the late 1990s showed the dangers of speculative excess. The 2025 crash had unique characteristics. The rise of passive investing created a new market dynamic. Algorithmic trading contributed to market volatility. These factors, combined with traditional risks, created a tinderbox. Section 6. Recessions. Shadow experts assess the fallout. In the aftermath of the crash, the big question on everyone's mind was, how bad would it get? Would this be a short, sharp correction, or were we headed for a prolonged recession? Economists and market analysts were divided in their opinions, but there was a growing consensus that a recession was a real possibility. The Conference Board's leading economic index, a closely watched gauge of economic activity, had been flashing warning signs for months. Consumer confidence had plummeted, and businesses were delaying investment decisions amidst the uncertainty. Adding to the gloom were the ongoing trade tensions and the Federal Reserve's predicament. The Fed, caught between a rock and a hard place, was now faced with the unenviable task of trying to support the economy without further fueling inflation. It was a delicate balancing act, and the risks of a policy misstep were high. Some experts argued that the Fed should cut interest rates to stimulate growth, while others warned that doing so would only exacerbate inflation. The markets, meanwhile, remained on edge, vulnerable to any negative news or data points. Section 7. A glimmer of hope, charting a course through uncertain waters. Despite the doom and gloom, there were some glimmers of hope amidst the wreckage. The American economy, while slowing, was still fundamentally strong. Unemployment remained low and corporate balance sheets were relatively healthy. The housing market, while showing signs of cooling, was not experiencing the same kind of bubble that precipitated the 2008 crisis. And while geopolitical tensions remained high, there were some signs that cooler heads might prevail. The path forward was fraught with uncertainty, but history has taught us that markets are resilient. They have a remarkable ability to recover, to adapt, and to ultimately reward those who maintain a long-term perspective. The 2025 crash, while undoubtedly a